Hello everyone and welcome back to the channel. This is Fair Value Finder, and today one of the value stocks that we follow had earnings. And these earnings are pretty important because they can tell us other information about the economy as a whole. So we're going to get right into this, see what's changed, make sure the thesis holds, and what kind of returns we can expect. So it was Union Pacific, ticker UNP, that had earnings today. Currently the share price sits around $210, and we're coming up with a fair value of 191. With the thesis over here, small revenue growth, 1%, not great, definitely under inflation target, but they're big on buying back shares, growing that dividend. That dividend looks decent. If the revenues do not continue to grow, that could be an issue though, because it is pushing the top end of what we'd like to see for a payout ratio for a stock. And then this year, they actually started to grow their assets and shrink their liabilities, when traditionally they've been just growing both of them, the assets more slowly than the liabilities. So with this thesis, we'd be looking at about a 7.6% growth every single year over the next 5 years in the intrinsic value of the stock. And that's almost on par with market, maybe a little bit below with the current economic outlook, probably on par, if not beating the overall market over the next 3 to 5 years. On a 3-year basis, essentially in line, 24% compared to the 26% you expect by buying SPY. And then over the next 5 years, 54 compared to 47. So you do get a better beat long term. We'd be looking at the share price, the fair value around 240 in 3 years. The stock currently sits around 210, so it's not bad. I do own some of this. I don't know if I'm going to be buying any more, but it is something that I'm keeping an eye on just in case it does dip down to, say, 190. With the earnings, this is what's important here, are looking at if they're on track to hit the goals for this year. And they are shy on a lot of metrics. Yellow means that they're not quite where they should be. This is the third quarter of the year, so they should be about 75% on most of these. They're about 2% shy on revenue, and we'll get into the actual earnings report and see the drop in revenue that they've experienced and why they say it happened. Gross profit is down. Historically, it's been in the 40s. It's down to 39%, which is definitely not something that we want to see. Total expenses are high, 2% higher, and they touch on that in the earnings report as well. And net income, they're shy by about 7% on that. Net profit percentage, they're shy of the target there. EBIT, they're very shy on EBIT. They have said that they're experiencing lower volumes and lower margins. So all of those are wreaking havoc on their financials. Earnings per share, they're at 69%, so they're probably not going to hit 11.17 for this year. Shares were trading up on this earnings report. They were up over 2% during trading hours and up another almost 2% after hours. So the market doesn't seem to mind too much. But we can update these, or some of these numbers, to try and get something better. It's looking like the new projection for this year, it's going to move from 11.17 to 10.28. Pretty big drop, as we would expect, 75% there now. And then the actual revenues, we'd now be looking for a $600 million drop down to just over $24 billion. And those will also adjust next year's metrics. So 11.46 for the new expected EPS next year, and 25.16 for the revenues next year. And we can take a look and see if that impacted much over here. And now we see lagging the market by a bit on the 3 years, just a little bit more, still beating out on 5 years by 6%. Revenues, we're not even seeing 1% growth anymore. So if we make this 0.5%, which is really not what we want to see, not a huge impact of that. Most of the actual value is coming from the growing dividend and share buybacks. Share counts, they're higher than we'd expect them to be. They say in their earnings report that they're not going to be buying back any more shares. So we're actually going to adjust this, and they will have bought back 2% this year, definitely shy of that 4% that we'd like to see. They're clearly having some cash flow issues. Those volumes and higher expenses are going to be eating into those profits. So it probably would not be a bad idea to stop buying back shares and to try and shore things up. One of the biggest things here are the assets and liabilities. We were expecting some growth in the liabilities. They've traditionally come through with growths in the high 1% range, and so far they've brought down their total liabilities by 1% this year. So we would be looking at the end of the year on their traditional growth path to be hitting almost 57 billion. Well, now they're down to 52.5, down $700 million from where they sat last year. And their cash is lower, likely due to, again, paying down that debt. So some of their debt's coming due. They are paying that down. It is making their balance sheet look better. So financials not be the best, but they can at least shore up the balance sheet a little bit more. Dividend, they're holding the dividend where it's at. It's going to come out to $5.20 this year. ROEs are sitting north of 20% where we like to see them, but the debt to equity ratio is high. And so that's likely caused by that dilution in the equity. At least the trends in the assets and the liabilities will help to improve that number, though. So we'll see where things end up going forward. If they had continued on their typical trends, we'd be looking at something in the realm of 5.35. Last year, they were at 4.38. At the moment, they're at 3.75. So definitely in much better shape than how they finished out last year. For a company like this, we would expect them to be pretty heavy in debt. That's part of the operational advantage that they have in the wide moat, because it's very expensive if someone wants to create a whole nother railroad line. And it's currently trading for a PE of 27, which is higher than it has traditionally been. So I would not be surprised if things sold down a bit, down to about that 190 that we were looking at. And with that, let's get into the actual earnings report and see what they have to say about how things are going. So here we have the news release and the financials. The CEO said that they face many challenges in the quarter, including continued inflationary pressure and a drop in carloads. Operationally, they gained momentum throughout the quarter, though, and their focus clearly is on safe. Operating revenues were $5.9 billion, down 10% by reduced fuel surcharge revenue and lower volumes. The volumes were down by 3%. They were part of the higher expenses were the rising fuel prices. So as gas prices come down, we could see the margins improving here, and that negatively impacted things by almost 1.7%. Freight car velocity was 200 daily miles per car, which was an improvement of 5% year over year. Productivity was 129 gross ton miles, 4% improvement. Average maximum train length was 9,537 feet, which was an increase of 1%. Workforce productivity decreased, though, by 6% to 985 car miles per employee. That's the lower volumes that they're seeing. It looks like they're getting more out of their assets and fitting more into a single run rather than spread stuff out because of the lower demand that they're seeing. So operationally, they are being a bit more effective, but the gas prices are really weighing it down. For the rest of 2023, they're going to maintain their dividend, and they don't plan to buy back any more shares. And that's what we had looked at on the metrics. Okay, here are the financials. Revenues were down 4% year over year. Total revenues down 4% as well. Operating expenses still up 1%. So operating income was down 11%, and net income down 12%. For the per share numbers, their earnings down 9% year over year. Average share count down 3%, and dividends up 3%. Here's something interesting where we see the revenues by sector essentially, and we can see that there was a bit of growth in grain and grain products. Fertilizer saw 4% growth, so that was one of the better ones. Energy and specialized markets, 5% growth. Forest products, 11% decline. Coal and renewables, 12% decline. So this is really showing what sectors are doing better and which ones are doing worse. Clearly, energy is not doing the best and potentially building too hot, while agriculture looks like it is picking up a little bit. For the balance sheet, we see assets grew from 65.4 to 66.5. That's some nice growth. Although cash was down, short-term investments were down. They did see some growth in other current assets. Their investments saw some growth. Properties grew, essentially flat on lease assets, and then other assets grew a tad. For liabilities, they were down from 53.28 to 52.53. Debt due within 1 year was up a little bit from what it had been at the end of last year. So they're going to be paying down some debt or refinancing, hopefully paying it down though in today's climate. Other current liabilities down just a tad. Debt due after a year is down quite a bit. That's probably one of the biggest drops here. Operating lease liabilities, deferred income taxes, and other long-term liabilities didn't see a whole lot of movement. So shareholders' equity moved from 12.1 to 14. And that's what I was saying with the moves in both the assets and the liabilities. They saw some pretty good gains in the shareholders' equity. And that's going to really help some of the issues that we see with the company. Here are their cash flows. So everything's summarized down here. Of course, with lower margins, lower revenues, we're going to see a lower operating we're going to see lower cash provided by operations, which is down about 1,000. Cash used in investing was up 100, and then dividends paid were up 18. So not a huge movement there, but cash flows are down quite a bit this year, moving from 2,149 to 954. And these numbers are all in millions. And that's what we're looking at for the company. So based off that, we can update our thesis a little bit and see how things might be impacted based on what the current outlook is. What if they don't buy back any more shares? They just hold the current share count, like they paused for the remainder of the year. That drops our returns by quite a bit because the main driver here is those share buybacks. We go from 7.3% returns if they're buying back 4%. To 4.4 with nothing. And then if they start issuing shares because they need to get some money to handle liabilities or whatever they need, then it continues to drop from there. A single percent drops it by 0.6 on our return. And that's why we really hate to see companies who are issuing shares consistently for really no reason. So it looks like it wouldn't be bad to hold, to weather the current storm and see how they come out on the other side. It looks like the big issues here are inflation and a slowing economy. And that's the tell from this earnings report, at least from what they're seeing, because they deal with a lot of different sectors, a lot of different companies transporting products across the nation. So it could be a sign for what's yet to come and something to be aware of. Like, if wood products are down double digits, maybe that's a sign to avoid construction or lumber companies. And if agriculture and food are the main things that are seeing growth, then that might be the sector to pivot to as we see how the economy evolves. But I want to thank you guys for watching this one. Please like if you enjoyed the video, subscribe so you can stay up to date with everything, and I'll catch you next time.